Hello and welcome back to our discussion on the preparation of financial statement. This is the financial statement series 2 and we'll continue our discussion on that. To recap, we say that every business decision will involve financial item and all the financial items will find place in the balance sheet, income statement and cash flow statement. And in the last session we saw we took an example to understand how the financial transactions will appear on the balance sheet, income statement and a cash flow statement. But in this session we will try to pick up one particular concept of financial accounting, which is the accrual concept, which says both the credit, accrual concept says both cash and credit transactions, credit transaction should be recognized, should be recorded immediately at the time of the transaction. See, the actual receipts and actual payment is not an important issue at the time of recognition. So this is a recognition principle. That means it tells us when to recognize the transaction. So therefore in this session we will try to see how this accrual concept affects the financial statement. Let us go back. In the previous case, or in which we saw, there was every transaction was a cash transaction. Everything was assumed to be paid in that period. Now let us take another example where we have more or less the same transaction, but we are purchasing the goods on stock, salary due but not paid, and also we are selling the goods on stock on credit, and we are purchasing the goods for cash. So it's a combination of cash and credit transactions. So let us start. So we are starting the business with 150,000, and so it is a receipt and a source. We are taking a loan of 75,000, so it is a receipt and a source. It's a receipt and the source. And you are purchasing the stock for 180,000. You are purchasing the stock, and that too you are making the payment immediately. So I make the payment for the stock, so it is a cash transaction. Acquisition of stock results in the payment or outflow of cash. Now you see, you sold entire stock on credit to X, so the sales is 330,000, but you don't receive any cash flow, so therefore I put that 0 here just to drive in that point. But since you have not received money, the entire sales will appear as an asset. Why should I record this transaction? We record the transaction because of the accrual concept. The accrual concept says the transaction should be recorded independent of the fact whether you receive the cash now or later. Now next, salary due but not paid. So salary is an expense. I pay the salary, but before I go to salary, let us complete the sales corresponding cost of goods sold. So you sold the entire stock, so therefore 180,000 is gone. So my entire stock has been sold, so in the balance sheet there will be no more stock. Then the salaries. Salary is an expense. I have to show that expense because of accrual principle, but I have not paid money for salary, so in the cash flow there is no salary, but there will be an outstanding salary. So outstanding salary, I'm sorry, I should better show it from expense. An outstanding salary is, so that means expense not paid. Let me write down an expense not paid. Because of this principle, expense not paid is a liability, and income not received is an asset. In this example, it was an outstanding salary was the example, and it was the debtor or the receivable is an example in this case. So salary not paid. Then in the same way, since interest is shown as 12%, I should show the interest. Interest will be for the year 0.12 for the year, And let us assume that I pay interest. So payment of interest results in cash outflow. No outstanding interest here. So all the transaction taken care. As a result, I have to find the profit. Profit is sales minus the expenses. The expenses are 180 plus 30 plus 9. So expenses are 219. Once again, there is a tax of 30%. So the PAT is equal to 77,700. If nothing is mentioned, as I said in the past, entire PAT is retained, so we call that as a retained profit. And we are also paying the tax, so the entire tax is an outflow of cash, so I show that as an outflow of cash, 33,000. So as a result, the cash inflow minus the cash outflow is a cash in hand, and cash in hand is a balance sheet item, so I show that. So if you see, the sources are once again equal to assets. So in this example, we saw credit sales, which is an outstanding expenses, to demonstrate the importance and the relevance of the accrual principle. So if there is a credit sale, there will be a corresponding debtor. Okay, there will be a corresponding debtor, and outstanding expenses, there will be a corresponding liability. An expense not paid is a liability, and income not received is an asset, was the objective of this particular example. This is coming from the principle which is accounting. In accounting, it's called the accrual principle or accrual concept. Thank you very much.